slightly off target there, very small amount. So if you look to the severance tax, you're right in line with your policy expectations, and below that, you can see the variance against the target by asset class. On page 23 of your packet, we show asset allocation against, for the other funds, targets, current, are you away from your target? In some cases you are. Staff has been moving closer to that. Pointing out also that on early childhood, you made an asset allocation change, added diversification and some more risk into that portfolio. So that's, that allocation is reflecting the target allocation change that became effective June 1st. And it'll take a while to get you there, but you can see that you're making progress and adding diversification to that portfolio. With that said, let's go to page 25 of your packet and look at performance. I mean, Vince talked about this, Matthias gave us the background for it, but the quarter return gross of these was 5.5, 5.4 net. Your fiscal date is the same as your 1 year, obviously, but that return is just incredible. Both your gross and net performance outperformed your policy index. So strong performance there, up 25.73 on a net of fees basis. Again, great markets. You've benefited from the great markets. If we look at the 5 year, which is discussed in your investment policy statement, a gross fee of 10.45 and net of fees at 10.28, also outperforming the policy index. So strong performance. For Vince and Matthias is that we don't expect this performance to continue, and it's been so strong it's affected on a positive way your longer-term numbers. Severance tax, a little bit different story, not outperforming the policy index in most time periods. Certainly it did for the quarter, but longer time periods it did not, and we'll look at why in a moment. First of all, on page 26, we're looking at attribution of performance for the quarter. And as we always say, your asset allocation decision is the biggest driver of return, and this shows that. Your strategic target allocation contributed 5.51 for the quarter. Being away from your target allocation was pretty neutral. Structuring under style selection was a slight negative. Part of that is a benchmark that is a long-term benchmark. But you did have manager value add in the quarter, just 0.11. But I do want to point that out, that there was manager value add. If you go to page 27 of the packet, you'll see the information for your fiscal year. Same story. Strategic allocation is the largest driver of your return. Being away from your target, in this case, slightly overweight to your equities, was a positive. The structure of, compared to your benchmark, was a slight negative, that you had manager value add of over 1.5% for the year. So that's for the land grant. If you go to page 28 and 29, let's just look at 29. Let's look at the 1 year, your fiscal year. This is for the severance tax. Again, asset allocation drives performance, but in this case, you can see there was no value, manager value add. There was actually negative. And if you go to the column at the bottom on the far right-hand side, you can see where that comes from. And this is, as we've seen each quarter, is that the private equity compared to the land, grant, is a detractor from the severance tax performance and can explain most of that negative manager value add for the severance tax. Same story for the quarter, but thought we'd just focus on the fiscal year. Any questions so far? Page 30 and 31, this is for calendar year, but it's looking at your beginning calendar year market value and then looking ending, and points out cash flow, net cash flow, and your actual gain and losses, in this case gain, by market value. And then we show by individual funds. This reflects on severance tax, the net cash outflow of over $91 million. You had a strong investment gain as well. You can also see the other funds that had net cash outflows as well for the first 6 months of the year. Performance for the funds, the other funds are shown on the next page. I'm going to go through that. Let's talk about how you did versus peers. I just want to point out again that how you do compared to your peers is not an objective. And I also want to point out that many of the peers and the universes are not sovereign wealth funds. There are sovereign wealth funds in here, but the majority would be pension plans. And some of those pension plans have a total return objective, some have an income objective. So it's interesting to know how you did to your peers, but you should not design your portfolio to be peers. With that said, if the top shows land grant, total fund performance that we just saw, and then we show the policy index. The first grouping is, we think, the most relevant of the peer ranks. For the quarter, there were 93 participants in that universe, and it's the all public plans greater than $1 billion. So again, this would include sovereign wealth and pension funds. For the quarter and calendar year to date, your ranks were above median. Next to land grant, total fund rank 44th for the quarter, top third for calendar year to date. Below median for fiscal year, although you did have a return to over 25%. We'll speak to why that is below median in a moment. And then for the 5-year, below median, but looking out longer term, 7 and 10, you rank above median. And we have other universes there. I wasn't going to go over them because we believe that the best universe to compare you against is that greater than $1 billion. If we go to page 35, page 19, peer ranks on a 5-year rolling basis. Looking at the far right-hand side of the chart, or we would say the third on the right-hand side, you see most of your 5-year rolling periods have been above median. That's where we want you to fall, to not, as you were before, you were at the top or at the bottom, but having that consistent above median returns. It puts you in a nice place for the long term. Recently, you've seen periods of this 5-year rolling. You have, that's because of the equity market that we've had, this rising equity market, and you are positioned a little more conservatively, as we'll look in a moment. So not concerned about that. We can understand about it, but you just pointing out that you have fallen below median, but it's in a marketplace where valuations are very, very high, and we've had lots of discussions about that. So if you go to page 36, this is looking at the 5-year rolling Sharpe ratio peer rank. So, why do we care about Sharpe ratio? Well, it's really a measure of risk-adjusted return for your portfolio. A portfolio with a higher Sharpe ratio is considered superior, and you can see that you fall in a good place. Your top quartile on your risk-adjusted return. The next page 37, is looking at your severance tax. Again, not surprising, the ranks are not as good there. Performance has trailed that of the land grant, and we've discussed why. Let's go to the following, which is page 38, and this is a little complicated, but this is looking at your asset allocation versus your peers. So this can help explain why in the recent time period, when especially domestic equities have performed way above historical levels, why you have fallen below median, a big portion of why. This is looking at that peer universe of public plans greater than $1 billion. and look at U.S. equity, which is the second column, you're at the point in time, as of June 30th, your target allocation or your current allocation to U.S. equity was 23.64. The number in brackets says that was a 66th percentile. So you had below median allocation to U.S. equities in a period where U.S. equities were driving, forward, just outperforming equities outside of the United States, certainly outperforming fixed income and outperforming alternatives for the most part. So having a below median allocation to U.S. equities was a headwind for you, but certainly expecting that sort of return from equities going forward, we would caution you not to believe that can continue. So any questions about that? I just wanted to point that we wanted to go over that because it does explain that below median, recent below median rank. Page 39 is looking at risk return versus peers. You can barely see it, but the land grant is the green, your actual performance on the top left hand. This is for a 5-year period. Looking at risk and return, land grant is the green triangle. You can barely see it. It's slightly above, right, almost on the red line. What this graph tells us is the gray squares are peers. And your severance and the land grant are there as well as your index. If we look at land grant, and you can look at the returns or you can look at the placement on the chart, land grant had close to median return, but had far less risk than the peers. Comparing it to the median for that 5-year period, you had 98% of the return of the median, but you only had 75% of the volatility or standard deviation of the median. So again, that explains the Sharpe ratio, a strong Sharpe ratio. You had almost all the return with far less risk. Looking down at the 10 years of that greater than $1 billion, same story here. You have above median return, 102% of the return of the median plan, but you did it at far less risk as well, 88% of the volatility. So that's a good place to be. But finally, I'm going to page 41. This is looking at asset class composite performance. There's far more detail in the pages that follow, but because there weren't any changes, at least to the public assets or manager ads, terminations, or concerns about a manager, which I was just going to review this summary page. The policy has you look at performance against the policy benchmarks on a 5-year basis. You can see, I will point out that on U.S. equity for the 5-year and 3-year, you trailed the Russell 3000 for your U.S. equity composite. The changes were made to that portfolio, and you can see the recent time periods. And for your fiscal year to date, you had nice outperformance. So when the market was rushing up, you did even better for the fiscal year. So strong performance. On non-U.S. equity, making some changes there, trailed, different story, trailed on the short term, but outperformed on the long term. And for the 5-year investment policy expectation, your non-U.S. portfolio met that expectation. Core fixed income, also looking outperformance in each time period shown here compared to the Bloomberg Ag, and for the 5-year period, strong outperformance relative to that Bloomberg U.S. Ag Index, so meeting the policy expectation. On non-core fixed income, been building out that portfolio, but also for the 5-year period, meeting your policy benchmark, and has strong outperformance against that benchmark, so meeting policy expectations. You will following the private equity, real estate, and real return, you'll receive reports from your specialty consultants there. I would say in the following pages, we would point out that in private equity, You didn't meet your expectation, policy expectation, but you did on real estate, and you also trailed for the 5-year slightly by 1 basis point for the benchmark on real return. So any questions on the total fund or asset classes, we're happy to review. But that is our report, unless you want to dig deeper into the asset classes.
Does anyone have any additional questions for Marcia or Matthias? Okay, well, thank you very much.
Thank you.
You got it. Let's move on to 2E, the National Private Equity Program. David Lee, and welcome, Mercer.
Thank you, Mr. Chair. This is David Lee. I'm on with Richard Hugmeyer and Amy Ridge of Mercer, and also Chris Cassidy, Portfolio Manager. This is the first quarter performance for the year. As the Council understands, private asset classes, the performance is lagged, so that's why we're talking about first quarter performance here. The format is the usual, where we have the performance update, and then behind it, we've got individual breakdowns of all of the funds by vintage year, exposure, and quartile, in case you have trouble sleeping. The long story short, the performance has been very strong on an absolute basis, and as a result, distributions have been very high, something that Vince referenced in some of his comments. And we are very happy to see a lot of these higher valuations being realized and being returned to the fund. With that, I will turn it over to Richard Hugmeyer to walk through the national performance. These materials, I think, start on page 92, and Richard will start on page 95, which is page 4 of the handout.
Thanks, David, and I'll try to move somewhat quickly and just illustrate more of these themes that both Vince and David hit on that we're seeing in the private equity portfolio. Starting on the first slide, we have an overview of the time horizon performance and also activity. The quarterly return was 9.6%, which was a very strong quarterly performance in the National Private Equity Program. It wasn't quite as strong as Q4, which had a 12%, but I think 9.6% is actually one of the stronger quarters that we've seen in the program's history. And because of the size of the portfolio now, this equates to a gain of about $295 million, which brings the total gain since inception from the national program to approximately $3.2 billion. The table at the bottom splits the portfolio by vintage years. These dates correspond to when the SIC launched a new private equity strategy for the national program in 2011. One of the things you'll see is the 2011 and after funds tend to have more influence on the overall returns for the 5-year and more recent time horizons, which makes sense since a lot of the value is realized in the older vintage years, but we still do not yet have 10 years of history with the newer funds. So you can see the since inception number is still influenced by the 2009 and before vintage years, since there's more history with those funds. One of the things to highlight is the strength of performance over the last year, with an overall net IRR of 44%, which is led by the more recent funds. Two drivers of that number being high. First, we have seen strong performance over the last 4 quarters. And then the second, if you'll recall, there was actually a sizable negative Q1 number due to the onset of COVID that actually dropped off of that 1-year number, which is one reason why it did increase so much quarter over quarter. Overall performance is at a net IRR of 12.3%. Since inception for the 2011 and after is at 17.5%. And for the 2009 and before is at 10.5%, which isn't expected to move too much since that portfolio is mostly realized. From an activity front, we've been active the first part of the year. We're already close to the amount we committed to in 2020, with $305 million approved to 5 funds across 4 managers, and we're looking to bring a couple more new commitments the remainder of this year as well. The next page, page 5 of our report, is a summary of the numbers in the portfolio. It breaks it down by by strategy as well. Buyout and growth continue to be the strong performers, with both strategies at a 13.4% net IRR and buyout having a slightly higher net multiple. If you turn to page 6, this really illustrates what is driving the net asset value increase, which has really been both performance and contributions that have been offsetting these great distributions that we've had in the portfolio. We started this trend of gains in Q2 2020 with 195 million, and then that increased to 228 million in Q3, and then 341 million in Q4, which has been the largest number that we've seen. So Q1 with a $295 million gain is the second largest gain that we've seen over the last 4 quarters. And to put the size of the gains in context for you, the quarterly gains that we were seeing in 2019 were about 100 million a quarter. So really, it's more than doubled a quarter in recent quarters. All strategies except venture capital contributed to the gain, but remember the national program has a small venture capital program. And the gains were widespread with 66 funds reporting net gains. The other trend that Vince and David hit on were distributions. And you can see here we had almost 200 million of distributions in Q1, which was slightly higher than what we had in Q4. And subsequent to Q1, we continue to see distributions be strong with 188 million through the end of June compared to 121 million of contributions. And from my perspective, when you see these performance increases like we've been seeing, you want to see realizations because the unrealized gains in a portfolio can be marked down like we saw in Q1. So it's nice seeing the value come back into the portfolio in the form of distributions. The next page, page 7, I just wanted to hit on another theme that we're seeing. When this recovery started last year, technology was very much the driver of the early performance in the portfolio, and it is still very much a part of the story. For example, when you look at the top quarterly distributions, 2 of the 5 are technology related, but now 3 of the top 5 fund distributions were not technology related. So we're seeing that these portfolio gains and the performance really spread to other industries. The same story when you look at the top reported net gains, where technology is still a driver of performance in some of those funds, but now we're also seeing, for example, healthcare companies that are also driving the gains. Slide 8 shows the performance by benchmark. Our goal is to be above median, and you can see since 2011, performance has been above median in all years except 2013. And 2013 was a good year from an absolute basis at 12.2%, but relative to the performance of individual funds in the benchmark, the portfolio is slightly below median, and really it's kind of driven by a couple of funds in that vintage year. One did a considerable amount of energy, another one's kind of a secondary fund, which ended up having a lower return because the environment wasn't as good for secondaries. The other thing to kind of note on this is absolute performance has really been strong across multiple vintage years in the 2011 and after years, with every year but 2013 generating a 14% or greater return. The next page shows a different way to look at benchmarking by doing a public market equivalent calculation and calculating an IRR using the cash flows from the portfolio with various public equity benchmarks. The MSCI ACWI benchmark covers multiple countries and geographies, and so it's similar to our focus in the national program. You can see the national program's outperformed by 5.9%. Public equity markets in the U.S. have had a very strong run. So the national program is under the Russell 3000, but above the Russell 2000, which focuses more on the smaller companies. And then I'll finish with slide 10, which really kind of goes into a summary of the different strategy components that we have. We have a 300 million to 400 million annual pace. We hit that range in 2020 with about 330 million closed. We are already within target through the end of May with 305 million approved and continue to look at both re-ups and new opportunities in the portfolio. From a sub-strategy and geography perspective, we're all within target. From a concentration guideline perspective, we do have one general partner that's above 10%, but with recent commitment activity and some realizations that we've seen, the exposure is now down to 11%. And the overall performance of that manager has been at a 15% net IRR. So it's been additive to the portfolio. And then from a fund series perspective, there are 4 fund series greater than 5%. But again, these fund series have been additive to the portfolio. The lowest performance of the 5 is at a 19% net IRR. And then as far as managers and number of funds go, we have been disciplined with new managers over the last 9 years that we've been managing the national program, with 29 managers that have received new commitments. There's still a lot of older funds in the portfolio. And if you take out the 2007 or older funds, we'd be at 66 funds. So we'd be within that, approaching that approximately 75 to 100 fund guideline that we set a while ago. But it has taken a long time for these older funds to be fully realized. And we continue to kind of track that progress as well. That concludes my comments. I'm happy to answer any questions that the council has.
I don't hear any. David, do you have anything additional to add on the national program?
No, I think that covers it.
Okay, well, let's thank you very much, Richard. Let's move on to 2G. I'm sorry, 2F, the New Mexico Private Equity Program, David.
2F, thank you, Mr. Chair. This is the New Mexico program. The performance has been a little bit different. Recall that we have a dual mandate here, so we're not strictly going for performance. And also recall that most of the funds in this program are venture capital investing in a lot of early stage companies. So there is a lot more risk. And then the final thing I wanted to add that would affect performance is we had some of this phenomenon in the national program when we had older funds that weren't as strong as the newer funds. But if you look at the trend in the national program PMR, you'll see that NAV reduced every year as we continued to add commitments. So even though it still affects performance, it doesn't affect it anywhere near it does as it did maybe 5 years ago. The New Mexico program is a little bit different, and that's because the legacy assets that we have tended to stay in the portfolio, have continued to be a pretty large part of the NAV. But on the plus side, I did want to point out that when you look at the breakdown for performance in the New Mexico program, we are seeing a lot of strength in the recent funds. And Richard will go ahead and go through that. And these materials start on page 120, and Richard will probably start talking about page 123. Go ahead, Richard.
Thanks, David. Yeah, it is a little bit of a different story with the New Mexico program, but the goals are different as well. We're going to start on a similar slide that shows the time horizon performance to give you a better sense of what's driving performance in the state program. We split the fund investments by 2008 before and 2016 and after. And if you'll recall, there was a requirement in the program for managers to open an office in New Mexico and staff with a senior person. And that requirement was removed, and it opened up really the possibility of adding even more managers to the program that became interested. And so that focus really began in 2016 and drove the reason for splitting the portfolio. The fund investments have generated strong performance, even though it is still relatively early for a lot of them. When you look at the fund investments since inception, these funds are at an almost 24% net IRR and have generated a $35 million gain for the 2016 and after funds. The challenge is the newer funds really don't have as much influence on the overall return because the relative size of these funds is smaller, and they have less history than the co-investment side of the program. From a return perspective, the co-investments have a large influence on both the near-term and since inception performance due to their longer history and larger size. And they continue to have influence because they're still largely unrealized. And you can see over the last year, the co-investment funds have generated flat performance, although quarterly returns were good, up 2.6%. We have seen some volatility in the quarterly returns for the co-investment funds, really driven by one of the largest holdings now being publicly traded. And then this causes a mark-to-market happening every quarter to the stock price, which has created that volatility. From a commitment activity perspective, we have done 2 commitments this year for $20 million and continue to look at different fund opportunities. We are near the 9% target on the New Mexico program, and so that's one of the reasons why you've seen less fund commitment activity right now. But we continue to kind of watch the realization activity in the program. If you go to the next page, page 5 of the report, we're continuing to see the trend of net asset value increases in the program. This quarter, it was driven by both capital calls and portfolio gains and equated to about $32 million of a net asset value increase. There's also been an increase in the since inception performance numbers over a 1-year period, driven by the newer fund commitments that we previously spoke about. So you can see that the net IRR since inception is 1.5%, and that multiple of 1.11 times. Note that the 10-year return in the graph below of 5.2% is better than that since inception return of 1.5%, which I think really shows the improvements in the program over the last decade. Page 6 is the breakdown of really the driver of the net asset value increase. You can see here the $8 million of contributions, the $19 million gain on this slide. Contributions have really been driven by the recovery fund drawing capital, and the gains are driven by write-ups in a couple of funds that we'll show on the next slide. Just to let you know, post Q1, we have seen $30 million of contributions, so that trend has continued along with $3 million of distributions. So we expect another net asset value increase as of June 30th just from the capital calls. The next slide, page 7, shows in the upper left table that the largest capital calls have come from the recovery fund as that continued to invest in Q1. We had one somewhat sizable distribution where a company was sold to a growth equity firm and received about $2 million from that fund. On the gain side, 2 of the funds had large write-ups, and it's really been driven by companies raising capital at higher valuations. The other gains were from the co-investment funds, which was driven by that mark-to-market that I was talking about to the publicly traded price, which improved in Q1. I'm going to skip the next 2 slides on benchmarking just because we do have a different focus in the New Mexico program. And I wanted to go to the economic development summary on page 10, which the recovery fund has really increased the numbers that we've seen on this page. The number of New Mexico companies in the program is now up to 102, with 25 receiving investments in the last 12 months. Now, not all 25 are from the recovery fund. We still have funds that are investing, but the recovery fund is a large driver of that. At fund level, it's at $427 million that have gone into New Mexico-based companies, with $76 million being invested over the last year. And like the number of companies, the recovery fund is a large driver of that dollar amount. Although we did have some funds also invest in New Mexico companies. On the next page are the updated job numbers. On page 11, we didn't actually have updated for the SIC meeting, but these are updated for the SIC meeting, and we did see an increase across the board. Jobs at companies that are in the portfolio, both realized and unrealized, are 2,638. That was about a 500 increase from last quarter's total jobs number. And the job growth increased to 617, which is an increase of 60 from last quarter's number. And the job growth numbers, a way to kind of measure what are these companies doing after receiving a investment from the New Mexico program, because we compare it to the jobs reported at the time of investment to what they currently are. And so we did actually see 60 jobs added from last quarter's number. The payroll, annualized payroll is 132.5 million, which is an increase of about 12.5 million. And expenditures on New Mexico goods and services is reported at 148 million. The next slides go into more detail about the different aspects of the New Mexico program, but I think we can conclude there for time, and I'm happy to answer any questions that the council may have.
Any questions about the New Mexico program? Thank you, Richard. David, anything further here?
No, that's it, Mr. Chair.
Okay, thank you very much. Moving on to 2G, Performance Report Q1 2021 Real Estate. Paul?
Thank you, Chairman Lavender. Paul Chapman again. The real estate PMR starts on page 146 of the PDF that Andy distributed yesterday. Andrew Bradley from Townsend will be handling the PMR presentation for Townsend today. In the interest of time, I've asked Andrew to kind of move through this relatively quickly, and then if you want to focus on questions afterwards, that would be fine. But you'll see that we had another strong quarter, and we outperformed the benchmark in all time periods shown, which I think is a good validation of the strategies we discussed earlier today and are set forth in the structure study. So hopefully what we've set forth will allow us to continue to outperform our benchmarks as we go forward. And with that, I will turn it over to Andrew.
Thank you, Paul. And as Paul said, I will shorten it up a little bit, just in the interest of time. So just to start it off, we'll hop in on slide 149 of diligent materials, or slide 4 of Townsend materials. I'll just give you a second to hop over there as we can hop it around a little bit on the agenda. Start off in the first quarter of 2021. We continue to observe recovering both the broader market and the real estate portfolio, as Paul said. The positive momentum we saw at the end of 2020 further accelerated into 2021, leading to our real estate investments generating a positive 2.9% net return for the quarter, outperforming our NFI Odyssey benchmark by 80 basis points. Solid quarter. As Paul kindly stated in his opening comments, and as you can see in the chart at the bottom of slide 149, the real estate portfolio outperforms our NFI Odyssey benchmark over all time periods. This being the case, whether you are looking at the total portfolio return or strictly the 2011 inception rebalance portfolio. If we move on to slide 150, the graphics at the bottom of the slide show income and appreciation of the real estate portfolio versus the Odyssey benchmark. On the left-hand side, you'll see income and appreciation breakouts for both the real estate portfolio and Odyssey benchmark on an annual return basis. Two things I would like to highlight from this graph. First, if you take a look at the periods when the economy stumbled or struggled, you will notice that high-quality income generation continue to be resilient. And second, if you take a look back over the last eight or so years, we have outperformed year in and year out, and that is including 2021 year-to-date numbers. The chart on the right-hand side displays the annualized total return breakdown for both the total portfolio and the 2011 inception rebalance portfolio. These are both versus the Odyssey benchmark spanning the same time period. On the left-hand side of this graph, you'll notice the annualized since inception total return of the real estate portfolio is in line with Odyssey index total return. When you take a deeper dive into this, you'll notice that the real estate portfolio delivered slightly lower income returns. This is due mainly to no core exposure from 2005 to 2011, which has been rebalanced and corrected since. The appreciation return generated by the real estate portfolio significantly exceeded Odyssey's appreciation return over the same time period. When you take a look at the right half of the graph, you'll find the rebalanced portfolio since 2011 inception. And you'll notice that the income return now closely tracks with Odyssey, while appreciation return continues to significantly outperform. Moving to slide 151 of diligence. Here you'll find our allocation growth and anticipated pacing going forward. As you read, based on the 12% current real estate target allocation, Townsend's most recent pacing model calls for approximately $300 million of new non-core commitments for 2021. As we stand today, well over halfway through this year, we have met that target with an overcommitment of approximately $156 million to the 2021 vintage year. And as we move on to looking at core, our pacing actually does not call for additional core commitments, but as you will see, $50 million of core capital has been committed to a new core fund in 2021. This was due to an opportunity arising with a strong institutional manager. New Mexico has an existing relationship, strong existing relationship, and it was in a favorable property sector. Obviously, the decision was made and brought in front of the council and approved the commitment. Just to wrap things up, 53, for those of you whom are following along, as of first quarter, the real estate allocation stood at 9.8% versus our target of 12%. This was a 10 basis points increase in allocation for core, driven mainly by the real estate portfolio increasing in value by over $158 million. This being net of distribution. Then lastly, to wrap up real estate, if you could all kindly look at slide 159 of Diligent, you'll find a 1-year return attribution. And for those of you who are unfamiliar with what an attribution chart is, it conveys what risk types have contributed positively to the 1-year net return and which risk types have subtracted from it. I think it's always good to highlight this chart as it provides a good high-level summary of what has occurred in the real estate portfolio over the past 4 quarters. When you take a look at the attribution chart, you will find that both the core portfolio and opportunistic portfolio have had the largest positive impact on the total portfolio. I think Paul stated earlier, 66% of the current portfolio based on net asset value as of 1 quarter, or first quarter. The opportunistic portfolio contributed positively, as it said. This right up across the portfolio as diversified global strategies continue their recovery. Then despite the struggles the value add portfolio has faced over the past 5 or so quarters, due in part to retail exposure and the impact of the global pandemic on this sector, the value add portfolio contributed positively to the 1-year total portfolio return as funds across the space experienced write-ups in value as the global pandemic slowed a bit. Lastly, credit contributed positively, though due to small size has had a minimal impact. I'll stop here and happy to answer any questions on the real estate you may all have.
Thank you, Andrew. Any questions for Andrew or for Paul about the real estate? Okay, hearing none, thank you. Let's move on to 2H, which is the real return portfolio. Paul?
Thank you, Chairman Lavender. I do want to point out, before we move on, Andrew was talking about that performance attribution, and I think what's happening now, he talked about the contribution of return, which is affected by the weight of dollars in each sector. But if you look at the returns associated, the 1-year returns, this is exactly what you would expect the lineup to be. Non-core, opportunistic, our highest risk sector, 16.2%. The next least risk, the next lower in risk is the non-core value add, 8.1%, and then the core at 3.5%. So that spread is probably more than we would get over the long term, but those are lining up exactly like we would expect them to. Okay, getting over to the PMRs or PMR for real return. This starts on page 184. You're aware, and has been mentioned earlier today, that we reduced the target allocation for real return from 12% to 10%. This was effective June 1 of 2020. With Q1 rolling off, which was pretty devastating, especially to our MLP portfolio, performance for the entire real return portfolio actually outpaced the real assets subset of the real return portfolio. And this is all because of the snapback of MLPs, which is really the largest portion of the financial asset bucket. So Andrew, why don't you take it over?
Thank you, Paul. Jump on in the real return portfolio performance. At Paul's stated materials start on 184, and I'll start on 187 of diligent materials. And Paul quickly alluded to it, but before diving straight into performance, I do like to note the big differences between the real return portfolio and the real asset portfolio, just so everybody's on the same page. Our real return portfolio includes not only the real asset positions, which are infrastructure, energy, timber, and agriculture, but additionally our allocations to financial assets and our MLP position, which Paul referenced. Before moving into performance, should highlight financial assets in our MLP position make up 17% of the real return portfolio as of first quarter. And the real return portfolio currently represents 8.7% of total plan assets. As noted earlier and multiple times throughout this call, the target allocation was lowered from 12% to 10% earlier this year. As we move on to slide 188, you'll notice that returns vary greatly between the real return portfolio and the real asset portfolio, specifically over the shorter term. On the chart below, you'll notice a 190 basis points difference over the quarter and 610 basis points difference over the 1 year time period. This difference the difference between the two portfolios lies in the inclusion of the MLP position in the real return portfolio. And as Paul said, since the onset of the global pandemic, we have talked at length about the MLP performance. It's been very volatile, and just to highlight the volatility of the position. Over the last 5 quarters, returns have varied from as low as negative 49% in the first quarter of 2020, when the pandemic started, and reached highs of positive 33% in the second quarter. The first quarter of 2021, the position delivered a positive 18.5 net return, bringing the 1 year net return for this position to a positive 74% as it recovers from its lows. As you can see on the chart, and as Paul quickly mentioned in his intro comment, the real return portfolio continues to rebound as performance was significantly positive for the quarter, producing a positive 4.2%. This was driven in part by the quarterly MLP return, as I just noted. Taking a look at the real assets portfolio, which strips out the MLP performance and financial assets performance, or if you need a visual aid, the lighter blue bar in the chart below. These investments performed well over the quarter, delivering a positive 2.3% net return, and continue to perform well over the longer term. I would like to note, given the primarily focuses on real assets, on the real assets portfolio, or specifically infrastructure, timber, and agriculture, with the energy portion of the portfolio being covered by your staff and other consultants. Outside of the first two slides that we just reviewed, we only show metrics based on the real assets portfolio. And with that said, and in the back of your mind, we can move on to real assets performance. Starting with summary on slide 190 of materials. You'll see our real asset allocation in the first quarter of 2021 was 7.2% versus that new target of 8%. This was a 10 basis point increase in real assets allocation quarter over quarter as the portfolio value increased $76 million over the same time period. Slide 191 of the material, you will see the historical real assets allocation and future pacing. Based on pacing in the 2021 vintage year, constant pacing calls for $330 million of new commitments, $200 million of which has already been committed to the infrastructure strategy. To wrap things up, I would like to highlight performance. That's typically what everybody's very interested in. Starting on slide 192 of materials, you will find the real assets portfolio versus the CPI plus 300 basis points benchmark. You'll see it over the quarter, 1, 3, and 5 year time periods. As Paul and I both stated earlier, real assets performance, the real assets portfolio performed well for the quarter. It also has performed well over the 1 year and has continued to perform well over the 5-year period, but is delivering underperformance over the 3-year time period. This underperformance driven by energy and agriculture portfolios. It's important to note that the portfolio is being measured against the CPI plus 300 basis points index, which has been and is currently being evaluated by NMSIC staff and consultants. Then the last slide I will focus on, slide 193.
Andrew, if I can just chime in real quick on slide 192, I think this is Seth with Townsend as well. And just one point to bring up is that 1 year number, that 8.3% is a significant rebound. So if you recall when we presented 4Q performance, so just 1 quarter ago, that was a negative 2.5% over the 1 year period. So that was taking into the full impact of 2020 of the COVID returns. And here, just dropping the first quarter and adding the first quarter of 2021, our return goes from a negative performance and underperforming to outperforming by a significant amount. We'll see this volatility. We've seen this volatility in this portfolio and will continue to, given the exposure to energy markets and how they've been linked to the broader market. But I wanted to point that out, that this outperformance was a significant increase from prior quarter. And then I think, Andrew, if you wanted to wrap up on slide 193, go ahead.
Yeah, thanks, Seth. That was a great point. But yeah, just to wrap up on slide 193, just like we did with real estate, I wanted to show the attribution chart. This time being over 20 quarters or 5-year net return. Consistent with previous reports, infrastructure remains the primary driver of performance, as you can see on the chart. This being due to its size and strong consistent performance. Energy was the other significant contributor over the 5-year time period. That both timber and the other category also positively contributed to performance, but due to their size, do not have as significant of an impact as infrastructure and energy. On the graphic, you may notice there is one red bar. This red bar is agriculture, and agriculture remains the lone detractor to the real assets portfolio over the 5-year time period. In specific, agriculture delivered a 5-year net return of negative 4.3%. And to provide a bit of context behind this underperformance, agriculture has been impacted greatly by a handful of things, including currency exposure in South America, this being primarily Brazil. Additionally, performance has been dragged by suboptimal yields on various fruits and in a decline in table grape quality in one of the fund's largest assets. And then lastly, a factor of underperformance that we always have to take into account is that agriculture vehicles take an exceptionally long time to generate returns. And that's just part of their nature. It's a very long-term asset class. But with that being said, the global pandemic and its impact on global demand and in the supply chain has not aided the agriculture sector in any way. And in the interest of time, I'm going to stop here. I can answer any questions you may have.
Thank you, Andrew. Any questions?
Harold?
Yes.
Yeah, this is Tim. I kind of need to go. Is you still have a quorum?
I think we're still okay, Tim, and I appreciate you saying that. I know there were 8 of us. 6 is the quorum. I think John does have to leave at some point, but I think we're okay. I don't believe there's any more action items. Well, thank you for coming today.
You bet. Thanks. We'll see you. Bye.
Okay.
Harold, Debbie on the call.
I'm sorry?
Debbie Romero is no longer on the call.
Okay. We may be short of quorum, but I think we're okay because we don't have any more action items. Any further?
This is just real quick. I didn't catch what the timber result was so far.
In the real return?
Correct.
Yeah. Seth? I'm sorry. Andrew?
This is Seth. I'll take it real quick. So over the 5-year return, over the 5-year return, the chart that Andrew was referring to, timber generated a positive 2.3% on its own. It contributed about 50 basis points of total performance time period. Timber remains slightly positive over the inception date of our investments there. We do have the full returns are towards the back of it, but it's quite busy. But over the life of those investments, we're at about a 1-1 multiple, so a little bit over our cost value and about 2.5% net return. Over the short term, the 1 year performance is slightly negative, and that's really due to, I think, the timber environment is unique. So timber pricing, lumber pricing has skyrocketed for anyone that's followed the timber markets. However, timber on the stump, the trees, that value has either stagnated or decreased, and it's really a result of the cutting and the manufacturing of timber. So a lot of those plants went offline during COVID. Therefore, there's limited supply, which really raised timber pricing. But the mills themselves are starting to come back online, which is where the value of our trees is really generated from.
What are we expecting going forward for the next year?
Short term, I think with mills coming back online, we should see an increase in value in the trees themselves. Timber prices have moderated a bit, but they're still significantly above where historical values. I think with the demand we've seen out of the building, sort of building and manufacturing and furniture, we anticipate the value of timber to continue to increase. It's a matter of getting those mills activated and really shipping out the trees that we own and those being really cut and distributed broadly. The other minor issue with some of the timber that we own is it's called pre-merchantable. So it's really a development strategy where those trees are too young to cut. They still need to grow. They're still producing and growing quickly, but we can't realize that value at today's prices just because they're considered too little or too small to harvest.
Member Austin, Paul Chapman. We have a lot of exposure to the southeastern United States. There's still a significant inventory overhang there. So, personally, I'm not expecting much in the way of go-forward returns for timber. But I would expect it, to be below 5%, but positive.
All right. Thank you very much, guys.
Sure.
Thanks, Lee. Anything further, Paul, on either of these two areas?
Nothing from me.
Okay. Well, thank you very much. I appreciate it. That moves us into, I think, the investment committee report. The minutes are in your packet, and basically you've seen the results of that meeting. So we'll move on from that to number 4, audit committee report. Nick.
Thank you, Mr. Chair and members. I'll keep it short here, but we met yesterday to review our audit plans, really, and just to let the council know that we established our entrance conference with Moss Adams, our independent auditor, and we went through a discussion on audit planning and those sorts of things. Obviously, the audit starts back early August, goes through November, and I believe is due to the state auditor on November 24th. And so there's a lot of activities that go on with that, a lot of examination of processes and internal controls and things like that. But I think one of the most important things for the council to know is that I believe that you may get a questionnaire, potentially a fraud questionnaire, that the auditors normally issue to council members. So don't be alarmed if you see that. It's a normal thing, normal part of the audit process. And that's basically it. We have a really robust timeline. And so I thank Brett and the team and Moss Adams for kicking that off and doing our audit that's required annually. Did I miss anything, Brent, if you're still on?
No, you did a fine job, Nick. Thank you.
All right, thanks.
Thanks, Nick. Moving on to 4B. Do you have anything further for us, Brent?
Harold, just a couple of things I wanted to point out. I'm on page 356. I did want to emphasize that the budget to actual schedule that is provided to the council is for July. That's the first month in the new fiscal year of fiscal year 22. Just be apprised that, with this first month of the year, there's only 1 month of actuals and 11 months of estimates in there. As we progress throughout the year, for instance, if we get to May, for instance, that's going to be 11 months of actual and 1 month of estimate. I think I emphasized earlier, and contrary to what I put here, I indicated that I didn't think we'd have any budget problems through the end of the fiscal year. After I thought about it a little bit more, I came to the conclusion there's a very good likelihood fiscal year 22 that we'll have to do a bar, but we'll wait and see what the market does. If the market rallies, there's a good opportunity that we'll have to request additional funds. But I would also emphasize that's a really good problem to have, because that means that our assets are returning some good dollars in return. So wanted to emphasize that. I think on number 2, the investment holdings report, Vince already mentioned, if you look at the land grant permanent fund, you'll see a new beta overlay. He had some excess cash, and he basically used the beta overlay to put that money to work. And then the auditors are, in addition to working on the audit, they have a September 30th deadline for the next agreed upon procedures report. As soon as I get that, I will forward it out to council. And then finally, I'm on page 399. I think Steve mentioned this earlier. This is the note page of the investment holdings report. You'll note on the first bullet that the monthly contribution from the state land office was $108 million, which was down about $25 million from the prior month. But I did want to emphasize, I think the prior month was a record, and that $108 million is still very, very strong. July of 2020, for instance, the state land office contributed a little bit over $37 million. So that's really all I have, Harold, unless there's questions from the council.
Any questions for Brent? I think it's important that we continue to recognize the terrific job he and his staff are doing, and keep it up. I love seeing these reports with no exceptions, so that's terrific.
Thank you.
You got it. Closing matters. Let me just say that the next SIC meeting is Tuesday, September 28th. Obviously, Steve and the staff will let us know whether it'll be virtual or whether it will be by phone. Moving on, public comment period. Charlie, do we have anything?
Mr. Chairman, no public comment has been submitted for today.
I appreciate that. I want to thank the council for putting up with and for their participation today. Does anyone have anything further?
Harold, I'd like to know if people could submit pictures, because I'm forgetting what they look like.
You know what, Lee? When you get that report that we've all been mailed, you'll see our pretty pictures in there, and they're up to date. So that'll give you a chance to remember what we look like. But I completely agree with you.
I wasn't asked to submit a glamour photo.
Oh, you look pretty good. When I compare how you look in real life to the picture, I think it's a pretty good likeness. Anyway, thank you, everybody. Go ahead. Thank you. I appreciate that. I got you. Thanks, everybody. I never have quite understood motions to adjourn. Can I have a motion to adjourn?
I'll make it.
Secondly. All right. I'll second that. Everybody, have a good one, and we'll see the investment committee in a few weeks. And thank you, everyone. Steve, anything further I should ask?
Not a thing, Harold. Thank you to each of you.
Thank
You
you
got
all.
it. Thanks, everybody. Bye.
Bye.